All right, welcome everyone to the Thursday Elite Zoom training. Great to see everyone's face. Today, I wanted to go over IUL, but last week we did an illustration for an option A, level A death benefit, and then today I wanted to do an option B, which is an increasing death benefit. So sometimes when you want to start the death benefit really small and increase it over time, that is a great strategy. But if the client is already older, I don't recommend it because what happens is the cost of insurance can be too expensive as it goes up every year. That now it's eating up all the cash value for the client and it can defeat the purpose of having an IUL. But I'm going to show you how to structure one. So let me go ahead and share my screen. So you log into F&G website. All right, we're in here. And on their sales tools, you're going to click illustrations. And you're going to click F&G Life Illustrations. And we're going to click Start New Case. All right. And today I want to use the same aged person, which was a 10-year-old female that we used last time. So I'm going to do the same thing. So we're going to go ahead and put child name. We'll just put Jane Smith. Right. And then we're going to, on the age, we're going to just put 10. Use a female. And then what we're going to do is we're going to just go to Nevada, product type, index universal life, find available products. F&G Pass Setter is the product. So you're going to select the quotes/illustrations. And owners, we're just going to put parent. So this is where you can make some tweaks on the illustration. IUL is a very flexible plan. So some clients can get an IUL for just more protection focus that has a cash value growth. Or some clients just want lifetime coverage. They want a coverage that never lapses, compared to like a term lapses after 10, 20, 30 years. Whereas the IUL can keep the policy going until they're 120 years old. So some clients are looking for permanent coverage. Then there's other clients who are specifically looking for a max accumulation IUL policy to kind of use it like their own bank and maximize their tax-free retirement later on. So I'm going to show you today if the parent wanted to set this child up for a future, what kind of illustration can you do to maximize the growth? Okay. So first thing you can do is I recommend for you to do a max accumulation and income solve. And the reason why I do that, it gives you a good guideline. And first of all, you can do a specified premiums. And most of the parents have a number figure, how much they want to put into it on a monthly basis. So monthly premium, you click on this. And let's just say a client wants to put $100 a month into this. I'm going to put 100. Go down and click OK. Pay premium to. This means up to what age or year you want to put the premium into this policy. So if you want to put age, up to what age you want to put the premium into this, then you can put capital A, 65. That means up to age 65. If you put a Y, That means it's how many years. So for the next 20 years, you want to put the premium in there, then it's Y20. So usually I use A because if the client wants to have a specific age that they want to accumulate the money to, then you can do that. Most of the children's policy, parents are thinking of their college, but IUL is not just for college. Compared to like a 529 college plan, this can be used not only for college, but later when they need to buy their car or want to put a down payment on their house, if they want to start their business, if they want to retire with a tax-free income, they can also use this in the future after their college. So I don't want to limit it to just college. So what I do is I put age and put 65. So what does that mean? We put that we're going to put $100 a month into the policy, and this will continue until age 65. And that's the illustration I'm going to do today. But does that mean the client have to pay until 65? No, not at all. Maybe the client only pays until she's 30 or 35, 40. So client can change that at any time. This is just an illustration. So this is a scenario. If you did put $100 a month, how much money will be in there and how much can the client retire with in the future? Okay. And throughout the process, client can use the money for college, client can use the money for other purchases. That's up to them. But a good standard is to put age 65. And then you don't have to touch anything here. Income type is a loan because under the tax code 7702, if you are taking out as a loan from your life insurance cash value, it is not taxable. So we're using that tax loophole to give our clients a tax-free income. Okay. And what we're doing here is we're going to start the age at 65. That means the income will start at age 65. But when you put 65, this actually shows at the end of 65. So starting at age 66 on the illustration. So my little tip is that if you put age 65 here, you don't have to put the A. You just put a number and just match that number. So if you put age 65, put 65 here. Years. This means that the income will continue for 25 years. So from age 65 for 25 years, how old are they? 90 years old, right? In America's life expectancy is about 79 years old. So 90, I think it's pretty generous, right? And client can have this even longer if they wanted to, but just for the illustration purpose, I'm going to do from 65 to 90 years old. And we're going to click OK. Once you do this, last time what we did was we did option A. Do you remember that? We did level. Today we're going to choose option B. Option B means that the death benefit increases every year, little by little. So what's the benefit of that? It's pretty simple. When you do an option B, the cash value that accumulates inside of the IUL gets added to the death benefit, original death benefit. Okay, so that means if the client took out the cash value, their death benefit will still remain as the initial death benefit. So if you started with $150,000 death benefit and you did an option B, that means the death benefit will go up to 151,000, 2,000, 157,000, $170,000, 880,000. It keeps going up while the cash value goes up. So even if the client took out $30,000 in loan as a tax-free money, that 150,000 initial face amount will be still there. So they're not going to get a discounted amount of death benefit. That's what it means. So down here, you don't have to do much because you already have put the solve for at max accumulation and income. And on the interest crediting options, take a look at the right side, illustration rate. It's showing 6.19, 7.20, 6.08, 5.25, 7.05, right? So these are the ones that is illustrating the best over the last 20 years or so. What do? I switch these ones that are lower and I put into 50% into Morgan Stanley. And then I erase the BlackRock And I go down and look at S&P annual point-to-point 100 participation is a 7.05, and I put 50% here. Then I diversified a little bit inside of the IUL so client can take advantage of the Morgan Stanley index and also the S&P 500 index. Okay, and that's it. And once you're done with that, you click on View and Print Illustration. And this is going to generate 20 to 30 pages of illustration. And I'm going to show you how to read it and how to explain it to your clients. Okay, go. So this is Jane Smith, female, 10 years old. Face amount 131,765. We didn't choose the face amount. If you remember, what did we solve for? We solved for max accumulation and income, and we chose a $100 monthly premium, right? So it calculated that the lowest face amount that they can offer her to maximize the accumulation is $131,765 face amount. Initial premium is $100 a month. If you scroll down to the tabular detail, if you take a look at here, to the right side, non-guaranteed assumptions, current interest. This is the average interest rate that they're showing over the last 20 plus years. Okay, 7.13, which is pretty good. The account value is showing the growth little by little. And surrender value, if the client wants to cancel the policy, that's the money that they'll walk away with. But if you take a notice that the face amount, it started at $131,765, right? But if you see the death benefit, what is happening? It's keep going up, right? So do you remember what I said about if the client wants to take out the money tax-free, they can take it out as a loan? So I'm just going to show you a hypothetical. Let's just say client is at the age of 30. Okay. So let's just say client is 30 years old. You see that? 20 years in. Client is 10 years old. 20 years from now, she'll be 30. She put in 24,000. How much is in there? 38,800, right? So there's more money in there than what they put in. And at this point, client has $170,000 in death benefit. So let's just say hypothetically, client wanted to take out about $30,000 out because she wanted to use some of that towards the down payment of a house. Okay. And then at that point, what happens? The 30,000 comes out from the account value. You see that right there? So how much would the cash value left after you take out 30,000? It'll be about $8,800, right? And that amount gets also deducted from the death benefit. So that $30,000 being deducted, that means $170,000 death benefit goes down to what? $140,000. But if you remember, where did the death benefit start? 131,000. So does the client still have more than what they started with in death benefit? Yeah, they do, right? They still have $140,000 in death benefit, even though they took out $30,000 in tax-free cash value. So this is a good structure if they want to maximize the cash value versus having more of the death benefit and living benefits. I'll tell you what are some of the great things about this and also not so good things about this. When you do an option B and do a max accumulation and income solve, this is really maximizing the cash value. So that means the client doesn't have as much of a room to put more money in there in the future because the modified endowment contract. So government puts a limit of how much money the clients can put in into a certain IUL policy based on how much the death benefit is. So the higher the death benefit the client gets, more higher the ceiling and more money the client can put in as a premium. If the client has a low death benefit, that means the ceiling is lower, so the client can only put only up to a certain amount of money that is less. So if a client says, "Hey, Sean, I want to put $100 a month for my child, but I see myself later putting two, three, four, $500 a month," then I need to make sure that they're not going to have to pay taxes on this by accidentally putting them into such a low ceiling IUL. Okay? Now, how do you verify that? You scroll down all the way down to take a look here, page 22. So under favorable tax treatment, okay. So if you take a look at this, 7 pay. 7 pay, it says how much? $4,933. 7 pay premium means that that's the amount the client can pay in maximum in a year for the first 7 years. So client can only pay up to $4,933 a year. So if a client told me, Sean, I want to start with 100, but I feel like I might pay $500 into this in the future, then $500 a month is how much a year? That's 6,000, right? So then what does that mean? That's more than what the MEC allows. So that's where it could be a problem. So understanding what the client is looking for upfront and leaving enough room so that the client can pay more money into it and let this grow even more. So that's how you determine if the option A or option B might be more suitable. The option B is great, but at the same time, when we use a max accumulation in income, it forces the death benefit to be as low as possible at 131,000. The ceiling is only $4,933 a year. Target premium. And the second reason, target. I know the client is paying 100 a month, right? So new agents might say, oh, $100 a month times 12, 1,200, my commission rate. Also, I'm going to make about this amount. But that's not how it works when it comes to a max funded IUL. Anything that is over the target, the insurance companies are really not making as much money because that money goes into the cash value, into the client's cash value portion of the policy. So out of the $100 a month, not all premium is commissionable. So you're not going to get commission on 100 times 12 and see the annual premium. You have to look at the target premium. So even though the client is paying 100 a month, which is 1,200 a year, the agent is only commissionable for 458 APV or $458 in annual premium. So agent might be surprised. Oh, I thought I was expecting this amount of commission, but the reason why it might be a lot lower than what you think is because you max funded the policy to where the death benefit is so low, and most of the $100 a month is going to the cash value, not the insurance. Does that make sense? Now, with this, I'm going to show you something. There is third thing that option B might be not as beneficial. Some clients, they don't just want cash value. They also love the living benefits of an IUL. They want to have the critical illness rider, chronic illness, terminal illness rider. This covers heart attack, stroke, major organ transplant, paralysis, ALS, aneurysm, tumors, burns. invasive cancer. It pays up to 100% of the death benefit. Terminal illness, chronic illness. This is like long-term care if the client can't do 2 out of 6 activities of daily living, right? So at that point, that is part of the death benefit. But if you start the death benefit too low, what happens? The client, if they have a heart attack, stroke, and cancer, client can only access 150 grand, right? If the client had cancer at 40, they can only access 232,000. So what you can do is you could potentially, if the living benefit is just as important to the client and they want to have a pretty big death benefit up front, then maybe it's better to do a level death benefit or start the death benefit a little higher so the client can have more protection as well. So IUL can be focused on death benefit and living benefits. IUL can be focused on just cash value focused, or you can just do some kind of a hybrid between the two. So something that is still has a pretty good death benefit and living benefits for the client, but still also has some good accumulation as well. So it's based on what the client is looking for, what I'm saying. Now, I'm going to show you the difference. $100 a month is $1,200 a year, and the cash value is growing. At the age of 65, what did I do earlier? I said the premium stops at age 65. No more premium goes in, right? You see, it's zeroed out at the age of 66 and above. But you see on the right side, it says 55,000. What is it? Withdrawals slash loans. This is an income this child will be able to start taking out at the age of 66, tax-free. How much is that? $55,621 a year. Isn't it mind-blowing how $100 a month, the parents paid into it, and you want to educate your child to become financially proficient. So you hand it to them and say, hey, now you have a job, you keep putting $100 a month into it, and this is going to be for your retirement and future. And even when the child continues to pay until 65, premium that went in is only $66,000 over the last 55 years. That's it. And how much a year is this person taking out in income a year tax-free? $55,621. So if this person live up to age 90, the mom and herself put $66,000 only, and this child would retire and receive an income up to $1.39 million tax-free. If this amount of money the parents puts into a savings account, what would they look like? That 66,000, how much do you think it would have amounted to? And a 0.04% interest. It might have been 66,500, maybe 67,000, maybe. But in this scenario, client will receive $1.39 million in income. But what if the client doesn't live up to the age of 90? What if the client only live up to the age 80? Then client would have received an income of 834,000. And look at to the right. Do you see the death benefit? $489,000 in death benefit. It will be still paid out to the family after this person passes away, after receiving an income of $800,000. So IUL is not a get rich quick type of plan. Okay. But also remember, these insurance companies has been around for a very long time. You don't want all your money into a volatile product, right? It happens all the time. People put into stock market, people put into different like Bitcoins or crypto, people put into the get rich quick type of things. And sometimes it's awesome. Sometimes you can lose it all. So my recommendation is diversify. So they have something in a safer account. Maybe not as, explosive growth, but something it's a little more secure. So that's kind of the balance that we're talking about. So when the client is asking for a long-term benefit for the child, I think this is one of the best things you can set up for your children or grandchildren. Okay. So Charles, you just had your granddaughter, right? So this is a perfect type of plan when my doctor clients, lawyer clients, when they have a new child born, as soon as they turn 15 days old, they sign up them for an IUL. So by the
So on
time
the
they go to
15th,
college, they don't have to pay for even college student loans. What'd you say?
so it's on the 15th day, or you is there's
After
something in the
15
comments
days.
said 14 days.
Yeah, 14 days. So 15 day, you're okay. After 14, yeah.
Oh,
So
okay.
14 days over and 15th day, you can.
I had a
So
question that
yeah,
so this can be set up by a parent or can it be set up by a grandparent?
you can, but for F&G, they want you to first apply as the parent, as the owner, but you can be the payer as a grandparent if you
Okay.
wanted to also. Yeah. So yes, you can. All right. Any questions?
Yes, I have one.
Yeah, go ahead.
Okay, at age 80, say at age 79, what you're on the screen now, the person went in and took out a loan for the max amount. What
Yeah.
would at 79, what will that do to the death benefit at that time? Will the death benefit go back to 130?
So can you give me an example with an actual age so I can answer it to you?
Okay,
What age?
age 79,
Okay.
they take out 100% of they take a loan for 100% of their value or whatever.
So
Like
surrender value, there's
1.5 million.
380,000. There's
Oh no,
380,000 left.
that's surrender. That's surrender. I'm talking about the accumulated value.
No,
You
you
said,
don't you don't count this because you already took out an income of
oh,
800
you're
grand.
right. You took
Yeah.
it out, so they don't
Yeah,
have it
yes.
anymore.
Yeah, we don't have 1.5. We have this number. Surrender value is the leftover cash value after all this income that you took out. So
So they can take, but they can still take out that 380,000. They can take out 90% or 100%
up
of
to
that
90%. Yes, up to
without
90%.
losing the policy.
Coverage. Yeah, exactly. Yeah.
And but that would leave their what would that make their debt benefit? If they did that. They took
If the
out
death
190. Yeah, what would happen to their death benefit? Would it go back to
Yeah.
130?
Yeah. So yeah, when you pretty much take out 90% of this, so yeah, it will go back to about 130, $40,000 or so.
Oh, okay, okay. That's what I
Yeah.
thought.
Yeah. Okay. And I saw another question here. Let me see. So option B is better if you foresee that you'll pay more in the future. So, Gale, actually, if you foresee that you're gonna pay more in the future, then actually starting the death benefit a little higher too is important. So in that case, you can start the death benefit still pretty high. That way they can put more money in the future because what's important with an IUL to prevent MEC is the initial death benefit that you set the policy up with. So option B can be great, but make sure you have enough target if you have enough MEC that you can put in the money into without being taxed. And if
Can
I
I
recall
follow up
from
on
last,
that?
yeah,
Is the MEC and all those guidelines, they're just based on the initial contract, like
death benefit, yeah,
the initial death benefit.
yeah.
But so like as the death benefit's going up like year by year, like at year 20 you're up at 200,000 or something as opposed to 100,000. That's not changing the
Yeah,
MEC and the
so
guidelines.
yeah, that can raise it by that time already you're past the 7 year MEC period anyways. Seven
Oh,
pay.
okay, got
Yeah,
you.
yeah. You
Yeah,
see what
yeah,
I'm
yeah,
saying?
yeah.
So
So
yeah,
it's
the
only
MEC
within
is
the first
only
7 years
important in
anyway.
the first 7 years. Yeah.
Right, 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 right. Oh,
So,
I'm totally missing that part.
so to take out a loan, you have to wait 7 years, correct?
You say what?
To take out a loan, you got to wait the 7 years, or
No, not at
can you
all.
max fund it for 7 years on the first year?
No, not at all. So you can if you start funding it from year one, you can still take out up to 90% of the surrender value any
My,
year.
my question was, can I put in 7 years worth of payments?
No,
Oh,
only once. Yeah, you can't put 7 years worth in 1 year. No, you have to spread it in 7 years and put the max amount that you can for
so
7 years.
how can people come in there and dump a big chunk of change in it? They have to set it up that way in the first place
Yeah, so then you can only put up to the MEC amount no matter what.
for that
You
one
can
year.
only put up to the MEC, yeah, annual basis. Yeah, so that's the MEC amount. If you put even a dollar more than that, then it becomes MEC.
Okay, so if you had a client that was going to put in 75,000, they want to take out loan out of that, you have to set it up that way.
Yeah, you gotta spread
So
it
so
out. That
so
75K, spread it out so that yeah, it doesn't pass the MEC. Yes.
okay.
Don, doesn't
Yeah.
it have a single payer or a single lump sum payment option?
You have a single payment option, but it doesn't prevent a MEC. That could trigger the MEC. So single premium can be great, but only up to the limit that the MEC allows. Because if you
Yeah,
pay
it's
more
still
than that, you can still have an IUL, but it's taxable now, the whole thing.
well, it would also they would raise the face value to prevent it becoming a mech.
What do you mean?
Well, it's option B. I'm not saying option A because option A is capped as how much they'll go up on the face value versus how much insurance you have.
Yeah, but option B, remember, the death benefit is going up incrementally, like only $1,000 death benefit, right? So like
Yeah.
150,000, 154, or 156. So it doesn't raise it that much. Does that make sense?
I,
It's not a large like increase every year that you can put a lot more money in there. It's
yeah,
really
not
more important to know about how you're set up in the initial death benefit. That's the most important part of the MEC.
Yeah, I remember asking them about the single, like dropping a lump sum in, and they're like, we don't
Mhm.
encourage it. It really doesn't grow better. Um,
Yeah.
so they might
I
be
mean, you
better off
can.
putting
I
that.
mean, we have clients who put the maximum amount. Yeah, and it is beneficial if you want to max fund it. You just not beneficial to put into a lump sum 1 year versus spreading out 5 to 7 years. The minimum we can do is about 5 year max funding it, but that could also you gotta talk to somebody that knows how to design it to set it up something like that. Okay.
Yeah, they'd almost be better off putting the difference in an annuity or something if they were going to sit on it,
Yeah.
not spend it.
And if I recall from last week, client can switch from option A to B and vice versa. Yes. So if they don't think they'll be funding more when they set up, they can change their mind and freely fund more. They can switch. Yes, they can, Kenny. So account value versus surrender value. Yeah. So the account value, that is the accumulation of the cash value, and the surrender value is the actual amount that you can pull out of the policy. So when it says 90% up to 90%, it's not from the account value, it's from the surrender value. Okay? That's the money that you can actually take out. The net death benefit, that means if the client passed away, that's the amount that they'll pay out. So if you took out a $30,000 tax-free amount from the policy and the policy was a $200,000 policy death benefit at the time, then you might only get paid $170,000 with an option A. If you had an option B, then that 200,000 death benefit, when you have a $30,000 cash value, would have raised to a $230,000 net death benefit policy. So even when you take out 30 grand, you still remain the $200,000 death benefit payout to the family. Okay. All right. So hopefully
Hey,
that was
hey,
a good
hey,
training.
Sean.
Yeah.
And also, if people call F&G,
Hmm.
they'll go over all these scenarios. They're really good about going over stuff with people.
Yeah, yeah, they have a great sales team and they help you walk you through it. They either do the illustration and email it to you, or they will walk you through it. If you want to have the F&G illustration software up, they can also walk you through it. Yeah.
Thank
All
you for it.
right. Yeah, you're welcome. And yeah, well, I'll get this posted at sometime today on the YouTube channel so that you can watch it. And then yeah, I'll see you next time. Have a blessed day. All right.